What is Eagle Eye? Well, Eagle Eye is our IPP internal model portfolio. Okay, before it was called Eagle Eye, it was literally called a model portfolio, a company's model portfolio. So that's so generic, the name. So we thought that by giving it a name, people can remember it easily. In this case, Eagle Eye. But it does convey something, doesn't it? It does convey that we watch over it, that we are paying attention to it, and especially for our clients, we do not just sell it to you and just leave it alone. That's what Eagle Eye is all about. The purpose of Eagle Eye is mainly to make sure that our client's portfolio is watched every quarter. In other words, it's rebalanced every quarter. We look at it every quarter, and we hope that in that quarter, if the market moves, we will adjust according to it. And more importantly, for Eagle Eye, we want to make sure that their risk portfolio matches their risk profile. That's why you have 4 different kinds of portfolio matching their risk profile. More importantly, we want to match our client's risk profile with the risk of the portfolio. In this way, the clients get the result from what they expect. What's so special about Eagle Eye? Well, for one thing for sure, it has something that is slightly different from the market. What's available out there is that it is willing to take risk off when the market is overbought, which is too high. Conversely, when the market is oversold, when it is bottom, we try to add on more risk. As you can imagine, in this way, it's likely that we beat the index, and that's what we hope to do. We want to produce or add some value to your investment, and that's what you hope. So that is the specialty of Eagle Eye. If you're totally new to investing, you've never touched investment in your life, first thing you would want to know and you want to figure out is your risk appetite. Now, why is that so? Because if the market drops 30%, the question is, can you handle that? Or, in other words, if your investment went from $1 to 70 cents, does it affect you adversely? If it does not, then yes, you may want to consider the stock market because that's where the volatility is. Its market can go up, market can come down. If you still want to invest, especially when you're more risk averse, then you may consider lower risk instruments like bonds or bond funds. If you were to invest, there's one thing you may want to consider, and that probably informs you of what sort of investment instruments that you want to invest in. That is your time horizon. Let me explain. For instance, if you need your money in 3 months' time, what happens? You wouldn't want to put it into a stock market because you're leaving yourself risk of market going down. Instead, you want to put it into some fixed deposit, and that's all good, 3 months. However, if you think you want to invest, you have a time horizon of 3 years, guess what? You may get a better return, or probably get a better return you put into the stock market as opposed to your fixed deposit. So, time horizon is important. Think about it. That will be your first step. What are red flags in investment? One thing for sure, it is when someone comes up to you and sells you a product that is too good to be true. What does that mean? What does that mean? Well, especially when someone comes out and say, hey, look, this investment will give you 50% return a month. Now, that's a red flag. That's when your antennas should be up. You should be figuring out why he said that. Because usually, return is equals to risk. The higher the return you expect, you should take the matching higher risk. It's a Newton's law of investment of sorts. So again, red flags is anything that's too good to be true, you need to watch out. One of the mistakes that people make during investing or while they're making investment is that they sell when market is low. It's emotions. See, look, you need to control emotions when investing, at least in the market. That's where people make most mistakes. Like I said just now, if the market is going down and everybody's panicking, you're not supposed to sell. In fact, you should be doing the other way around. You should buy when the market is low. Conversely, when the market is going up, when everybody's happy, exuberant, most of people make a mistake by following the trend. Instead, you should be taking some money off the table and wait for the market to correct. Another mistake could be that you're following a stock that you do not know. Just because your uncle, auntie, your friends tell you to buy, you just jump in. But guess what? When you jump in, that's when other people start to sell. And that's where you get yourself in trouble. For example, penny stocks. Penny stocks is something you need to avoid unless you know a lot about the stock. If not, stay away, because there are other players out there who knows the stock better. And when the market goes up, don't follow. Look at the fundamentals, analyze it. If you still like it, then you buy. But do not follow blindly. Hope that helps. What are the resources out there? Guess what? There are lots of resources out there where you can learn how to invest. Not only are there books, nowadays there are a lot of videos and the YouTube channels. I can hear good advice from a lot of experts. And do especially tune into CNBC, Bloomberg. These are good channels where you hear fund managers explain why they think what they think about the market and about stocks they buy or sell, or even funds. These are good learning places. Do that. However, do protect yourself as well. As much as there are good advice out there, there may be advice that may not be that great. They are unguided ones, it may get you into trouble. So what else can we do? One of the things that I can advise is to check in with a seasoned financial advisor. In this case, it's IPP Financial Advisor. When you check in with a seasoned advisor, it helps you not only save you time in terms of the knowledge, but also they will point to you what are the things that you otherwise wouldn't have thought about. For example, it could well be your needs going forward, near-term needs and long-term needs. All these are considered when you talk to a financial advisor.